Hedge funds charge fees on money they don't even make, and somehow wealthy investors keep paying. Here's the thing about hedge funds, they're not a mystery wrapped in a riddle. They're a business model that works asterisk because asterisk the math is rigged in their favor. Not illegally rigged, just structurally. A hedge fund manager takes your $10 million, holds it for a year, loses 2% and still walks away with a check. That's not genius. That's incentive design. Exhibit 1, the fee structure. Most hedge funds operate on what's called 2 and 2% of assets under management annually, plus 20% of profits. 2% sounds small until you realize it's paid asterisk whether the fund makes money or loses it asterisk. A $1 billion fund generates $20 million a year in base fees alone. The manager's rent is paid before a single trade is executed. Exhibit 2, leverage. Hedge funds borrow money against the assets they manage. If you give them $10 million, they might borrow $40 million more and deploy $50 million total. When markets move 5% in their direction, they've made 25% on your capital. But leverage cuts both ways, losses amplify too. That's why risk management isn't philosophy here, it's the whole operation. Exhibit 3, short selling. A hedge fund borrows shares of a company it thinks is overvalued, sells them immediately and bets the price will drop. If it does, they buy the shares back cheaper and pocket the difference. It's not market making, it's directional betting. And unlike a mutual fund manager who needs the stock market to go up, a hedge fund profits from collapse. Different incentives entirely. Exhibit 4, illiquidity. Your money isn't accessible next Tuesday. Most hedge funds lock capital in for years. That's not a bug, it's the feature. Long-term holdings mean fewer taxes on gains, more time to compound, and fewer redemptions during downturns. The fund manager sleeps better when they can't be rushed. Now, here's where it gets interesting. A hedge fund's returns don't need to beat the stock market by much to justify their fees to wealthy clients. If the S&P 500 returns 8% annually, and a hedge fund returns 9% but with half the volatility, the wealthy investor sleeps better and pays the premium. They're not chasing maximum returns, they're paying for asterisk stability under pressure asterisk. Exhibit 5, diversification across strategies. Some hedge funds run long-short equity, betting on individual stocks going up and down. Others trade derivatives, currencies, or commodities. Some use algorithms. The point, if one strategy tanks, the others might hold steady. It's portfolio construction as a professional discipline, not guesswork. Exhibit 6, the talent acquisition advantage. A hedge fund can pay a trader $5 million a year because the upside is uncapped. A mutual fund pays salary and bonus within regulatory bounds. Over time, the best traders migrate to hedge funds. Better talent compounds into better returns, which justifies higher fees, which attracts more capital, which attracts more talent. It's a flywheel. But here's the honest part. Hedge funds fail constantly. They blow up. Managers miscalculate leverage, miss market shifts, or simply run out of luck. The 2008 financial crisis wiped out dozens. The 2020 volatility spike crushed others. The model only works if you survive long enough to collect fees and catch a winning streak. The real question is why wealthy people keep funding them. The answer, because a hedge fund's risk asterisk structure asterisk differs from public markets. A billionaire doesn't need maximum returns, they need their money to not vanish in the next recession. A hedge fund manager's entire reputation depends on surviving volatility. That alignment of incentives is worth the fees. So hedge funds aren't mysterious. They're transparent once you see the incentives. The manager gets paid to manage risk and hunt for returns. The investor gets access to strategies unavailable in public markets. The system works because both sides know exactly what they're paying for and what they're betting on. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next story about how fortunes are actually built, lost, and defended. Subscribe so you don't miss the next story about how fortunes are actually built, lost, and defended. This video is for educational and informational purposes only and is not financial advice. Always do your own research.